Everything in this video is not intended as investment advice. It is for educational purposes only. I'm Josh Olszewicz, the head of research at Valkyrie. Let's take a look at the midweek market update. Some interesting news regarding custody and a few other small things I wanted to highlight that have happened over the course of the week that certainly aren't going to move the needle in a bear market, but definitely help move the needle in a bull market. Part of crypto is being able to access, being able to onboard, having proper custody that's safe, having services that you're able to pay for and sort of close that economic loop where you're earning crypto and you're using it as a payment for services. That's critical for a lot of developers, certainly. We had BNY Mellon this week come out and say that they were accepted by New York to hold Bitcoin and Ethereum, and it doesn't get more institutional than BNY Mellon, certainly. And you can see the slow changing of the guard amongst all the big banks, amongst all the payment services, slowly moving on board. To be honest, the institutional push for crypto, in my mind, has happened extremely quickly relative to where this asset class was in 2015 even. So I think we even underestimate the speed at which amongst the crypto natives this stuff can happen. And attitudes are certainly changing in that regard. As far as utility and closing the payment loop, Google partnered with Coinbase to accept payments for cloud services, which helps sort of close this Web3 loop. And they sort of mentioned this in the article. But again, we want to see more utility, more payments, the ability to use it as an actual currency, digital assets, that is great for someone like me. It's great to develop the use case narrative that this stuff is not just speculation. It has a purpose in the world other than gambling, right? Which it certainly does for many people around the world. But it's good to see these services continually built out. Now, on the other side of that, one interesting thing that happened with PayPal this week, sort of an unforced error, is they released this policy that they later rescinded, saying that if you are caught violating certain judgment policies, I'm not exactly sure what their thinking was here, promoting misinformation, that you'd be fined on your PayPal account directly. And I don't think it matters which side of the political spectrum you're on. You can see that how there's problems with this policy. And it was swiftly reversed, but it was interesting that it was sort of released, floated, gotten feedback inadvertently or on purpose. But again, it illustrates and highlights the need for decentralized payment rails and why we exist, why we're here, right? Sure, in the US, we have 5 different fintech apps for payments, but those walls may be closing soon, especially if policies like this are enacted on many various platforms. Another sort of banking headline where crypto's merging into TradFi is this MakerDAO, who is a stablecoin issuer, investing 500 million of their treasuries, or 500 million of their reserves into US treasuries and corporate bonds, basically becoming more Tether-like, becoming more USDC-like. And if you are a crypto native on the decentralization camp, you may not like this, but if you are a fan of Maker and maybe want to see them garner more inflows that aren't just crypto native exogenous dollars, I guess you could put it, right? It's not just crypto anymore. MakerDAO started as only accepting ETH as collateral, which was kind of a nightmare considering how volatile ETH was. MakerDAO had a lot of trouble maintaining that dollar market value for its quote-unquote stablecoin. They tried to adjust rates. They tried to do a bunch of stuff. Eventually, they introduced multi-collateral DAI, and then later on added a USDC as a component of that. So if we look now, 53% or more, depending on how you want to double count this or not, is USDC in the underlying collateral of DAI. So even at this point, is this really a decentralized stablecoin? Centralized stablecoins are great, don't get me wrong, but don't try to call this a decentralized stablecoin when it very much is not based on the collateral, right? The collateral is reliant on a centralized issuer. And we know those work great. Tether's had issues. They've cleaned up their act considerably. Circle's always, essentially, in my book, been top of board, all their ducks in a row from a regulatory perspective. So it makes sense if you're MakerDAO to, sort of skip the middleman of USDC and go straight to the banks. And if we look at the stablecoin circulating supplies across the board, USDC continues to decline. I mentioned last week that their rates have continued to decline on their yield platform. Rates kind of across the board have declined for stablecoins in the lending and borrowing space because there just isn't a lot of appetite right now for risk on. And if those yields are based on supply and demand is down significantly, there isn't a need for that supply, right? Tether has risen slightly in the same time period. That Circle has come off significantly here. Binance USD in the blue here keeps rising as they announced last month that they're only using BUSD pairs from now on. Their stablecoin uses Paxos, which is also extremely above board from a regulatory perspective in that they post monthly attestations of reserves. And the purple here is DAI, which some might argue, this is the MakerDAO product now, that with the ability to connect to banks directly, we may see another competitor in the stablecoin space that's more closely related to the fiat-backed reserves than the crypto-backed reserves. BUSD is another crypto-backed reserved coin. And we may see BUSD overtake USDC in the bear market because Binance still has a considerable amount of trading activity. As far as on-chain activity across the board, not much has changed week over week. Here's BTC. If we look at active addresses, which are addresses that have changed in value over the past day, this is a 30-day average. Transaction counts, fairly self-explanatory, and essentially flat, not much change here. In a bear market, you could argue these numbers actually look outstanding considering the typical drawdown we see in a bear market. This was 2018, and then prior to that, where we saw very little activity just in general. So it'll be interesting to see when this starts to diverge. Something that's catching my eye now in the divergence sense is hash rate, because hash rate is continuing to go up and up and up and up as price is sort of sitting at lows ready potentially to go lower. So there's a massive divergence there between mining profitability, which is only continuing to decline on a relative basis, and hash rate, which is continually being added to the network. There were three reasons that are most likely for this. The first being a new generation of ASICs are coming online. And that's always going to push efficiency higher. That's going to push hash rate higher. The Texas miners that were curtailed over the summer are no longer having to curtail power, so they are back online full-time by the looks of it. And the third prong of the rationale being that the inefficient miners have sort of collapsed or been sold off or been absorbed by, consolidated into more efficient miners, and they're putting those ASICs online again. So if you're able to get power at 3 cents per kilowatt hour versus 6 cents or higher, for instance, that could be the game changer. Or if your overhead is significantly less, if you're able to scale, there's all sorts of factors here, but that will push hash rate higher as well. All this hash rate that came offline is just being added right back to the network regardless of price, because this tells me miners are still profitable even with price at this level. And we can also look at hash rate a different way. If we look at hash price, which is the expected value of hash rate, sort of giving you this profitability angle or viewpoint, you can see this is 2018 hash price, terahashes per day, rather significant compared to today when we are seeing essentially an all-time low for hash price. So between block rewards, transaction fees, and network difficulty, so the difficulty that it is to solve this algorithm, the value of hash rate continues to decline because you just need more and more of it on a relative basis because difficulty is so high. And we may see, if we have a leg down, we may see hash rate decline significantly, 20 to 50%, as we sort of have seen that in the past. This was 2018. Here was the COVID drop here, kind of hard to see on the chart here. But the point is, inevitably, we will see a shakeout of mining of hash rate should price dip lower. Looking at layer 2 for Lightning on top of Bitcoin, which is sort of like a debit card system, we're continuing to see more and more deposits into that layer 2 on top of Bitcoin, which tells me that there is a utility there, because you wouldn't move your Bitcoin from layer 1 to layer 2 unless you were using it or you were putting it somewhere for something, you're doing something with it. So this tells me there's definitely a use case that is growing here over time. Lightning is great for microtransactions or sort of retail, paying for a haircut, paying for a coffee, sending your friend some money. Think of it as analogous to Venmo or Cash App in that sense, where instead of a centralized ledger, this is a decentralized ledger, and it's near instant and nearly free. I'm talking pennies here to send transactions. And we're finally seeing that use case kick up steam here. Looking at ETH, much like BTC, on-chain activity, active addresses, transaction counts, these aren't analogous one-to-one to bank accounts, for example, or number of people in a store, right? It's not like foot traffic or anything, but it does give you a sense of sort of who's here, what they're doing, and why. Some of this is staking rewards, just like it is for Bitcoin. It's hash rate or miners. But even in the bear market, there's still utility and activity here. And ETH's transaction counts rising slightly week over week. Active addresses fairly flat. The number of validators, these are the number of consensus mechanism enforcers or rule enforcers of the chain, have continued to increase as well. The rate at which they're being added to the network has slowed since the merge, but they're still being added to the network. And as we see successive code build-outs for the network on ETH, we're probably going to see more and more validators get added. It's just that right now, if you put 32 ETH or less into a pool, it's locked in the network, and you don't have a way of removing it from the network. That code is being written, tested, and implemented, but not yet released. Here's another look, different view of total number of validators on the network. So between validators and this fee burning mechanism, ETH has the potential to go deflationary. It has picked up steam slightly. Again, you can see that on the transactions chart. This chart is, to me, the single most important chart for Ethereum. It boils down everything you need to know. Is there utility? Are people here? Are they doing anything? Are they spending money transacting on the chain? If they are, for whatever reason, if it's NFTs, if it's trading, if it's lending and borrowing, whatever it is, it's going to show up here. We're going to have more burning activity of tokens, and this will push ETH into a more deflationary emissions schedule. Even if the ETH price declines significantly, you would think that eventually this supply-demand dynamic would kick in. Now, it may take 6 months to a year, right, to kick in. It's not going to kick in immediately. But this scarcity, just as it has for BTC, should have an effect eventually for Ethereum. So Ethereum's issuance is effectively 0% or less at this point. BTC is at around 1.77%. The only other network that I really saw a large bump in activity this week was Polygon or Matic. And they just had continuous stream of partnerships and sort of external crypto use cases, even throughout the bear market, whether it's NFTs. I saw some Ocean initiative tracking things on chain. And to see those partnerships is one thing. I've seen tons of chains through the years announce XYZ partnership, and you don't necessarily see activity pick up on chain. Now, that isn't to say that it's correlation is causation here, but we are seeing significant pickup in active addresses on Matic week over week, nearing all-time highs. In a couple of weeks, this could be beyond all-time highs for Matic. And as far as what this is, it's a sort of layer 2-ish, layer 1 for Ethereum for scaling purposes. Somewhat newer chain that sort of emerged over the past couple of years, but they are the shining beacon on the hill when it comes to on-chain activity recently. Flipping gears to technicals, if we take a look at Bitcoin with Bollinger Bands, which are these yellow lines here, 2 standard deviations away from price, above and below 20-week, in this case, moving average. When volatility declines, you see these bands contract. When volatility expands, you see the bands expand. And when we're in the process of this Bollinger Band squeeze, that tells you, okay, get ready for something to happen here. Not immediately, these things, again, take time, but it gives you an idea what to watch for as it's unfolding. And perhaps most importantly, as the squeeze is occurring, where price is relative to that 20-week moving average is critical at sort of tipping the hand of the market or the bias one way or the other. And you could say, arguably, since 2015, these B-band squeezes have been nearly 100% hit rate. Aside from COVID, which, we could say if COVID never happened, maybe this bull run would have happened anyway, right? You could say, well, the bull run happened harder because of money supply increasing. But in any case, currently it's projecting price potentially moving lower because it is below that 20-week moving average. Now, it isn't as tight of a squeeze yet as it has been in these prior squeezes, which have sort of led to explosive breakouts, right? Even in November 2020, to many people, this looked like nothing. But on a technical basis, it was incredibly important because volatility was contracting significantly. Many people are sort of comparing current volatility to the pre-2018 breakdown. Now, there are others that are comparing the current price action to post-2018 breakdown, early 2019. So it remains to be seen what's going to happen here. But one thing I will be watching week over week is where we are relative to that 20-week moving average, especially as the volatility continues to contract. If we look at some more trend metrics here, Pitchfork, MAs, previous all-time high, we're still chopping around that zone above and below that 2017 all-time high. Try as we might to get out of this downward channel, we're still tugging back into it. And we're definitely still below the 200-week moving average, still below the 200-day moving average. We're below things we need to be above in order to be confident that we're bullish instead of bearish, right? So as we contract volatility, we wait for this next move down. Trend metrics are telling you, yes, there's an expectation that this does move lower. So unless things change sort of in a dramatic way back above that 20-week moving average, the expectation right now is we break lower lows. We have CPI this week in the US, which is expected to print 8.1. If that's hot, if that's high, if that's elevated in any way, I expect all of risk assets to just get clobbered, right? That's just been the MO, because that means the Fed needs to raise more for longer, and we're not yet far enough down the road where we've started to beat inflation in a big way, right? So it's definitely something to watch for. Can we hold this level with the CPI print Thursday morning? If we do, the alternative is this W double bottom we're starting to create. It's a giant mess, but it's there. And if we're able to retrace back above the 200-week to this 25K level, then we form a technical pattern called an Adam and Eve, a V and a W. Sorry, a V and a U. But that is probably a few weeks out at this point. And another sort of rare occurrence that we don't see very often, if ever, I'd have to check this, but the 200-day EMA and the 200-week MA crossing would be significantly bearish, or tell you what you already know in that this trend has been significantly bearish. From ETH's perspective, really more of the same for ETH in that it's still within this bearish channel at the 200-week moving average, at the yearly pivot, at the previous all-time high, right? All this stuff is sort of just waiting for a catalyst, with the assumption in my mind that we do test lows here, because nothing to me looks like a setup for a reversal. If anything, you could argue bear flag, bear pennant type of activity down here. But on top of that, again, we've got this CPI print on Thursday that I expect to be better than last month. But if it's not, then certainly it's going to be a bit of a bloodbath. And even with the burning mechanism kicking up, right, you could argue ETH may retest 1,000. It may retest the June lows again based on this trend channel. On the flip side, some good news. Matic, again, arguably has a reversal pattern, unlike Bitcoin, unlike Ethereum, in that it has this falling wedge that it's slowly built over many months here. And if CPI isn't too hot, this thing could break higher, in that that's what the technicals are indicating, right? If we look at just levels, if we look at volume, haven't had a volume breakout quite yet at highs, so you'd certainly want that. I'd love to see volume come in above 90 cents. And the expectation here based on the measured move, somewhere around $1.34, which is basically the previous breakdown. So that's all I have for this one this week. Let me know what you think in the comments below. Like, dislike, comment, share, subscribe, and happy trading.